Welcome to Education. Some point, like, subscribe, comment. Inventory management interview questions and answers. What is inventory control? Inventory control is the process of reducing inventory costs while remaining responsive to customer demands. By this definition, a store would want to lower its acquisition, carrying, ordering, and stock-out costs to their lowest possible levels. However, a store would need to have enough inventories to meet any needs of its customers. What does inventory affect in a store? Inventory levels and their values can affect the income of the store, the amount of taxes paid, and the total stocking cost. What are the important considerations in inventory control? Inventory control to work at its best, a store must consider the costs of acquisition, carrying, ordering, and stock-out. The store must also look at its reordering system, its budgeting for inventory, insurance, and forecasted demand. What are the types of reordering systems that can be used in inventory control? The fixed order quantity uses fixed quantities of goods ordered at various order points to replenish inventory. The fixed order period use fixed times of reorder with various order quantities to replenish inventory to preset levels. The final system, just in time, uses a constant flow of goods to match the level of demand. What is the importance of EOC? EOC level is the point at which stocking costs are at their lowest point for a given item. What makes EOC work for inventory control? EOC works if its four assumptions match the case it is used on. The assumptions are: A. Annual demand, carrying costs and ordering costs can be estimated. B. Inventory level is divided by 2, no safety stock, goods used uniformly and are gone by next order. C. Stock out, customer responsiveness and other costs not considered. D. No quantity discounts. Inventory controls are followed. What can I expect? Inventory policy. You should be able to realize important advantages in inventory control. The first is reduced costs for inventories, along with reduced amounts of inventory. Theft and shrinkage should also be reduced if inventory policy is followed. The final benefit will be increased profits for the store. When should a physical inventory be taken? A inventory should be taken at least once a year. If items are perishable, seasonal, or highly demanded, a inventory should be taken more often. Can forecasting help in controlling inventory? Yes, through the use of forecasts, inventory levels can be set to meet the demands while keeping levels as low as possible. What is cycle count? A cycle count is an inventory auditing procedure, which falls under inventory management, where a small subset of inventory, in a specific location, is counted on a specified day. Cycle counts contrast with traditional physical inventory in that a full physical inventory may stop operation at a facility while all items are counted at one time. It helps to see the difference between actual stock and book stock. Book stock is the stock available in the system. What is opening stocks? At the beginning of the reporting period, or after a cycle count, the stock available in your inventory account is the opening stock. It is also called as beginning inventory. So, there's an opening stock. Then, lots of transactions happens, items are purchased and sold. And finally closing stock is calculated. What is closing stock? Closing stock is the amount of inventory that a business still has on hand at the end of the reporting period. This includes raw materials, work in process, and finished goods inventory. The amount of closing stock can be ascertained with a physical count of the inventory. It can also be determined by using a perpetual inventory system and cycle counting to continually adjust inventory records to arrive at ending balances. Closing stock is an asset. In inventory account, it is under debit. In trading account, it is under credit. Because it is still not traded.
Why is procurement considered such an important part of inventory control? Procurement is the backbone of inventory management. Inventory specialists have to create and maintain liaison with vendors and suppliers, and customers to ensure that supplies are obtained in a timely manner and that there are no shortages when the need rises. What are the important considerations in inventory control? Inventory control to work at its best, a store must consider the costs of acquisition, carrying, ordering, and stock out. The store must also look at its reordering system, its budgeting for inventory, insurance, and forecasted demand. What are finished goods? Inventories are those completely manufactured products which are ready for sale. Stocks of raw materials and work in process facilitate production, while stock of finished goods is required for smooth marketing operations. Thus, inventories serve as a link between the production and consumption of goods. What is COGS, cost of goods sold? Formula? For manufacturers, cost of goods sold, COGS, is the cost of buying raw materials and manufacturing finished products. For retailers, it's the cost of obtaining or buying the products sold to customers. Opening stock, beginning inventory, plus purchases, closing stock, end inventory, equals COGS. If the company is in a service industry, COGS is the cost of the service it offers. COGS can help companies work out how much they should charge for their products and services, and the level of sales they need to sustain in order to make a profit. The price paid for products is particularly crucial to retailers, as it is often their greatest area of expenditure. But all businesses can benefit from an analysis of COGS, as it can highlight ways of improving efficiency and cutting expenditure. Do you have regular visibility into excess and obsolete stock, and is it linked to targeted action plans to sell off or reduce this inventory? Excess and obsolete stock stems from ineffective sales forecasting, planning, or using a business model that fails to factor in product complexity and life cycles correctly. Inventory leaders establish processes to determine why excesses are being created and then develop a plan of action to sell it off. In some instances, the fear of the write-off has led to a large build-up over time of obsolete inventory. Are you able to break down your operating inventory into the three major categories when reporting levels: safety, replenishment, and excess or obsolete stock? This breakdown makes it easier to make sound decisions about appropriate levels for each of these three areas. It helps determine the minimum safety stock needed to provide an insurance policy against supply chain problems, either from manufacturing glitches or distribution uncertainties, so that customers get what they ordered. It's useful for pinpointing the amount of inventory required to replenish deliveries every 2 weeks. And it helps companies find ways to avoid a backlog of excess or obsolete inventory. What should be recorded in a physical count of inventory? When conducting a physical inventory, the classification, location, and number in stock of a good should be recorded. What makes a good forecasting model? A good forecast model will have reasonable costs. The accuracy of its forecasts will allow good decision making. The model will have ample data available for its use and a relevant time span. The model finally will have a low interference level. How can the value of inventory be determined? The value can be found using 4 methods in inventory control. The first is the specific cost, in which each item's cost is added together for the inventory's value. A second method is to use the weighted average of the costs for a period to determine value. A third method is first in, first out. In this method, value is measured using the latest costs of goods while working towards the beginning of the period until all goods in inventory are valued. The final method is last in, first out. In this method, the costs of goods at the beginning of the period are used to determine the inventory's value, much like FIFO. What is total stocking cost? Total stocking cost is the cost to the store of holding a good in its inventory. The stocking cost consists of the carrying cost times half the quantity in inventory. What is work in process? Inventories are semi-manufactured products. They represent products that need more work before they become finished product for sale. How do you calculate inventory turnover? Inventory turnover is a measure of how quickly a company sells its inventory in a year, and is often used as a metric of overall operational efficiency. There are 2 popular ways of calculating inventory turnover. The first method consists of dividing the company's annual sales by its average inventory balance, whereas the second method divides annual cost of goods sold, COGS, by average inventory. What is work in process? Inventories are semi-manufactured products. They represent products that need more work before they become finished product for sale. What is total stocking cost? Total stocking cost is the cost to the store of holding a good in its inventory. The stocking cost consists of the carrying cost times half the quantity in inventory and the order completion cost times demand divided by the quantity. What should be recorded in a physical count of inventory? Conducting a physical inventory, the classification, location, and number in stock of a good should be recorded. What is an ABC indicator? An ABC indicator is an indicator assigned by the ABC analysis procedure. An ABC indicator provides details of the consumption value of the material involved in the ABC analysis. The ABC analysis is performed by multiplying the current price of the materials by their quantity. The different consumption values are given as follows. A materials, important parts, high usage/consumption value. B materials, less important parts, medium usage/consumption value. C materials, relatively unimportant parts, low usage/consumption value.